Mastering Mutual Funds, your ultimate investment guide. Welcome to the channel, everybody. Today we're talking about building wealth and securing your financial future through the power of mutual funds. You know that thing, investing? That thing everyone puts off because it seems complicated and risky? Well, I'm here to tell you it doesn't have to be that way. We're breaking down the walls of Wall Street and making investing accessible to everyone, regardless of your background or income level. Whether you're dreaming of retiring early, buying your dream home, or just want to make your money work harder for you, mutual funds can be your secret weapon. So, grab your notepad, get ready to take some notes, and let's unlock the world of mutual funds together. Step 1. Define your investment goals. Before you even think about picking a mutual fund, we need to get crystal clear about your why. What are you actually saving and investing for? Is it the classic dream of retiring early, sipping margaritas on a beach somewhere? Or maybe you're picturing yourself finally owning that dream home, the one with the big backyard and the white picket fence. Maybe you're thinking about your kids' future, wanting to make sure they have a solid financial foundation for their education. Whatever your goal is, write it down, make it tangible. Put that goal somewhere you'll see it every single day. This is your driving force, your motivation to keep going, even when the market throws its inevitable curveballs. Trust me, having a clear goal isn't just some motivational fluff. It's essential for choosing the right investment strategy. For example, if your goal is 30 years away, like retirement, you have more time to recover from potential market downturns, so you might lean towards higher risk, higher reward investments like equity mutual funds, which focus on stocks. But if your goal is closer, say buying a house in the next 5 years, you might prefer lower risk options like debt mutual funds, which focus on bonds. These might not offer the same explosive growth potential as stocks, but they're generally more stable in the short term. Remember, investing isn't one size fits all. It's about tailoring your approach to your specific goals and timeline. So, spend some time really thinking about what you want to achieve with your money, and let that guide your investment decisions. Step 2. Understand your risk appetite. Alright, now that we've nailed down your goals, it's time to talk about something equally important, your risk tolerance. This essentially means how comfortable you are with the possibility of your investments going up or down in value. Think of it like this. Are you the kind of person who enjoys riding a roller coaster with all its twists and turns and drops? Or do you prefer a calm, scenic Ferris wheel ride? Your answer will tell you a lot about your risk appetite. If you're someone who thrives on the excitement of potential high returns, even if it means weathering some storms along the way, you might have a higher risk tolerance. You're probably comfortable seeing your investments fluctuate in the short term, knowing that over the long run, they have the potential to grow significantly. On the other hand, if you get queasy just thinking about your investments losing value, even temporarily, you likely have a lower risk tolerance. You prioritize protecting your capital and prefer investments that offer more stability, even if it means potentially sacrificing some growth. There's no right or wrong answer here. The key is to be honest with yourself about how much risk you're truly comfortable with. Don't try to be a hero and invest in something that keeps you up at night. Remember, investing should be a tool that helps you achieve your goals, not a source of stress. So, choose investments that align with your risk appetite and allow you to sleep soundly at night. Chapter 3. Step 3. Start early, invest regularly. Now, let's talk about one of the most powerful tools in your investing arsenal, the magic of compounding. It's been called the eighth wonder of the world, and for good reason. Compounding is like a snowball effect for your money. When you reinvest your earnings, those earnings start earning their own returns, and then those returns earn returns, and so on. It's like a chain reaction of wealth building. But here's the kicker. The earlier you start investing, the more time your money has to compound and grow exponentially. Think of it this way. Let's say you start investing $100 a month at age 25. Assuming an average annual return of 7%, by the time you reach 65, you'd have over $230,000. Now let's say you wait until you're 35 to start investing the same $100 a month. By 65, you'd only have around $100,000. That's a difference of over $130,000, all because you started 10 years earlier. That's the power of compounding in action. Now I know what you might be thinking, but Graham, I don't have a lot of money to invest right now. And that's okay. The beauty of mutual funds is that you can start small and invest regularly, even if it's just $50 or $100 a month. The key is to start somewhere and be consistent. Chapter 4, Step 4, Stay invested for the long term. Now let's address the elephant in the room: market volatility. The market goes up, the market goes down. It's like a roller coaster that never quite stops. And when you're constantly bombarded with news headlines about market crashes and corrections, it can be tempting to panic and sell everything. But trust me, that's the worst thing you can do. Remember, investing is a long game, not a get-rich-quick scheme. You're in it for the long haul, not for quick profits. So instead of trying to time the market, which even the pros struggle to do consistently, focus on what you can control: your investment strategy and your emotions. When the market dips, don't panic. Instead, see it as an opportunity to buy more of your investments at a discount. Remember, when you buy low and hold for the long term, you're essentially setting yourself up to sell high in the future. Of course, I get it. It's easier said than done to stay calm when the market is going haywire. But that's where having a solid investment plan and understanding your risk tolerance comes in handy. When you know why you're investing and what you're investing for, you're less likely to make impulsive decisions based on fear or greed. So stay the course, ride out the storms, and remember that time is your greatest ally in investing. Chapter 5, Step 5, Diversify your portfolio. Okay, let's talk about one of the golden rules of investing: diversification. You've probably heard the saying, don't put all your eggs in one basket. Well, the same principle applies to investing. Diversification essentially means spreading your money across different asset classes, sectors, and geographies. Why is this so important? Because it helps mitigate risk. If one of your investments isn't performing well, the others can potentially cushion the blow. Think of it like building a strong, stable house. You wouldn't build a house on just one pillar, right? You'd want multiple pillars to distribute the weight and make it more resilient. Diversification is like building those extra pillars for your investment portfolio. Now, there are various ways to diversify your mutual fund investments. You can diversify across different asset classes such as stocks, bonds, and real estate. You can diversify across different sectors such as technology, healthcare, and energy. And you can even diversify geographically by investing in both domestic and international mutual funds. The key is to find a balance that aligns with your risk tolerance and investment goals. Remember, diversification isn't about eliminating risk entirely. It's about managing risk effectively so that you can sleep soundly at night, knowing that your investments are well positioned for the long term. So there you have it, your crash course in mastering mutual funds. Remember, investing doesn't have to be intimidating. With the right knowledge and a little bit of effort, anyone can build a brighter financial future. Start by defining your goals, understanding your risk tolerance, and then jump in with consistent investments. Remember that time is your greatest asset, so don't wait to get started. The sooner you begin, the sooner you can harness the power of compound growth and watch your wealth soar. Thanks for watching. If you found these tips helpful, make sure to like, subscribe, and hit the notification bell for more investment advice. Happy investing.